smart entrepreneurs know how to stack different tax strategies and structure businesses appropriately to minimize their tax burden. And we talked in the last 2 episodes about the One Big Beautiful Bill, or OB3, the new tax bill passed on July 4th. I want to talk through 2 specific strategies and how they're getting stacked together. So we're going to call this the Billionaires Playbook, because these are strategies that billionaires often use, but so can entrepreneurs, middle market entrepreneurs. We're going to go through these 2 different strategies, QSBS, Qualified Small Business Stock, and the Qualified Opportunity Zones again. I know we touched on those last few.
One thing that I think we should just say in general is that too often entrepreneurs run around and they do this tactic or that tactic.
Yeah.
And there's no overall strategy and there's no coordination of everything.
Yep.
And it's like the quote I like to use from The Art of War: tactics without strategy is the noise before defeat. So just running around and taking these different strategies or tactics and kind of mishmashing them together, the magic is in all the things going on in your situation and having these strategies work well together. So I think it's great that we're going to show these stacking type of different strategies on top, but that's kind of a microcosm of what you should be doing in every area of your finances. Is should be a well thought out plan that works together, not just a strategy here or a tactic there.
Yeah, I agree. And I think oftentimes we see people chasing what I'd call like a tax product of just something that's artificially created just to, artificially reduce taxes. But at the end of the day, to me, the whole goal is to build wealth. I mean, isn't that what we're actually in the game of doing, of building wealth, protecting wealth, managing wealth? And taxes is just a drag. And so if we can reduce our taxes, then that allows us to build more wealth. And so it's just a means to an end. Instead of just chasing these kind of tactics or strategies, these are ways to structure your business appropriately. And they're not necessarily just
along
products.
The lines of what you just said, I think as a business owner too, we've seen business owners where they're constantly chasing revenue. I just want to make more money, make more money, but they're not increasing their EBITDA or their profit, and they're not increasing the intrinsic value of that company for a future exit.
Right.
And just chasing revenue numbers may be cool to brag to your friends about, but you're not building true wealth in the company. And the same thing in your private life, in your personal life. Entrepreneurs so often they have all this money flowing around, but they don't have a strategy or a plan to really build true wealth. And that's the game, is building true wealth. That's what we're all after.
The only thing I would say is that if you're in SaaS, don't listen to what you just said, because you're generally selling off of revenue multiples, not EBITDA multiples.
That is true.
But,
which, by the way, even in SaaS, it's not as much as it was.
Yeah, it's true. Times have changed.
Yeah, it used to be, 18, 20 times revenue with some of those exits we saw.
I wouldn't know. I wish my business was a software business. All right, let's talk to QSBS. So let's just remind the listeners here, Qualified Small Business Stock. This is for C corporations. You have to have less than $75 million of assets on your balance sheet to be a qualified small business. So that's how they define small business. You have to have, again, be a C corporation. There's certain industries that this doesn't apply to. If you're in consulting, if you're in hospitality, you can't qualify for this. And really what it says is that, hey, when you sell your stock and you hold it for 3 years, you get a $7.5 million exclusion from gain. If you hold it for 4 years, you do, I think it's, what is the math there, $12 million?
Yeah,
75% of $15 million. I don't know what the math is there. If you hold it for 5 years, you get a 100% exclusion, or $15 million on the $15 million gain there, and then or 10x your basis.
By the way, next time it's better to say it's $15 million and you get 50% after 3 years, 75% after 4, and then 100%, because then you don't have to do all the math.
Yeah, well, we didn't do the math. I tried, but I couldn't do it. So that's qualified small business stocks. So again, really good for businesses that are looking to sell in 3+ years. That's kind of the gist of it. Now, we're going to stack that with qualified opportunity zones. As a reminder there, you can roll capital gains into these designated areas called qualified opportunity zones. You can also create a qualified opportunity zone business. You can actually operate a business in these specific geographic areas that are designated by the governors of every state, and they're low census tract areas. The whole idea from Congress is, hey, let's push capital to be invested in these low-income areas and make a tax incentive. So that's really what the qualified opportunity zone is. And then if you roll your capital gains over, you don't have to pay taxes for 5 years. You get to kind of punt on paying the taxes. So it's a deferral technique. You get a partial step up in basis, really said another way, a partial elimination of taxes, 10% by default unless you're in an urban area. Then it's a 30% reduction in the taxes that you have to pay after that 5 years deferral. But then the big kicker is if you hold it for 10 years, whether it's property or the business in this area for 10 years, no taxes due at sale. So again, they're trying to incentivize long-term capital flying into these low economic areas and sticking around for at least 10 years. So these are the strategies we're going to dive into. What did I miss here to set the stage?
No, I think that's exactly right. I I think all those are, and it's interesting on the QOZ, they actually in the law, it's just a fun fact, is they will not increase your basis after 30.
Yeah, it's weird. They're like forcing your money out after 30 years.
After 30 years. So if you put $1 million in, sell it after 10 years for $2 million, no taxes on that $1 million gain. But if you hold it for 30 years and that $1 million grew to $10 million, now you pay no taxes on that $9 million of gain. But they won't keep doing it after 30 years. So you can't let it go on for 50 years or pass it on to your family that way.
Which is weird because you could just sell the property, you would pay no gains, take your money, and then just go do it again, I guess.
Yeah.
All right. Well, the last piece that we're going to break down, because this is going to be used in our example, is an F reorganization. And an F reorganization is really a way to do a tax-free restructuring of your business, because a lot of entrepreneurs we see are taxed as S corporations. They're an LLC. They pop it open with their state. They eventually, file Form 2553 to elect to become an S corporation because they hear that, hey, I can save some money on taxes. And that's true. But if you want to do that qualified small business stock strategy, as I mentioned, you have to be a C corporation. So how do you go from an S corporation to a C corporation without paying taxes or creating a tax bill? It's called an F reorganization. And so what happens here is that if I am an S corporation and I want to flip to become a C corporation to start my 3-year clock, 4-year clock, or 5-year clock to become qualified small business stock, I can do an F reorganization. And then the way that it works is you do a valuation. You got to get an independent third-party valuation of your S corporation. And then you're going to get either the larger of, again, that $15 million if you hold it for 5 years, or 10x your basis. Your basis is the fair market value of that S corporation that you've then contributed into this new C corporation. So as an example, if I'm worth $10 million, I do a third-party valuation, I'm worth $10 million as an S corporation. When I convert it to a C corporation, now when I sell, I get the larger of $15 million if I hold for 5 years, or 10 times $10 million, which is $100 million completely tax-free. The nuance is that first $10 million, that is going to be all taxable at capital gains tax rates. So it's only above that $10 million valuation, all that upside is going to be 10x. So give you a little nugget here.
You would take that all day long.
Take that. If I'm going to sell for $100 million, I'll gladly pay $10 million, the first $10 million of taxes and not pay anything on the other 90.